Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's winning trade. Well, hello everyone. My name is John Locke, and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and make sure you are aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated trades and/or results in the presentation, and they are believed to be as accurately represented as possible. But keep in mind that live results can vary for many, many different reasons. All right, if this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locking Your Success LLC, and myself and my team help traders win in the market and in life as well, and I'm here to guide you through the realm of high probability income trading. Now in a moment, not now, but in a moment, we're going to go over the winning trade, but before we do, let me quickly explain what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they would be otherwise. Now, when you find that you want more information as you're following along, that's fantastic. Simply contact us at lockingyoursuccess.com or ask a question in the comments in this video, and we can direct you to where you can find the information that you desire. Okay, let's move on. The winning trade we're looking at today is known as the rock trade. Now, the rock has been and continues to be our best performing rule-based strategy by far over the last 10 years. And that's because the rock is what we call an adaptive strategy, meaning it's traded differently depending on the implied volatility skew, which is why it has performed so well over such a long period of time. And if you don't know what implied volatility is, that's fine. It's not necessary for this video. So just sit back and enjoy. Now, before we get started, just understand that the rock is a rather advanced strategy and that the market environment during the demonstration was very variable. In other words, it was not particularly friendly, meaning that the position was adjusted a lot. Therefore, in order to get through the demonstration, we will be staying with the major concept of how the position works, and we're going to save the exact rules for another time when we have a simpler trade to review. So this is a trade that we do on the Russell 2000, and for the purposes of demonstration, we're going to use a $50,000 capital size, which is rather large, but keep in mind we can trade the trade with as little as $5,000. And the profit target on this example is going to be 20%, or $10,000 of the trade size that we're going to have on, and the exit loss trigger is also 20%, or $10,000 with our $50,000 trade size. If we pull up our analytical software here, this is what the position looks like on start with the volatility skew that we have. And this is what we look like on an analytical chart. So let me show you how we got here. This position can be entered multiple ways depending on what the market's doing. But essentially what we're going to do is we're going to come in 30 days to expiration, and we're going to do what's known as an entry test. And for an entry test, we're going to enter a butterfly with 50-point wings, about 20 points below the market. And if we wanted to simulate that here, we'll take these three options out and we'll move them up here. And we'll take away the call. And we're going to take a look at a symmetrical butterfly. And what we do is we look at the T+0 line, which is this dashed line here. And we primarily look at the delta. And depending on what that delta is, we're either going to enter in a more condor type of a position, or we're going to enter in more of a butterfly call type of a position, or a broken wing butterfly type of position. In this particular case, we have a relatively flat T+0 line. That being the case, we're going to enter a butterfly position with a call. So if we were to look at this butterfly position by itself, this is minus 110 delta. And if we add a call that's around 90 delta, that's going to give us around minus 18 delta. Now we want to flatten that out a little bit. And to flatten that out, we use essentially vertical spreads. And we could either use vertical spreads, we could really use vertical spreads anywhere in the position. But a lot of times we'll move the shorts or the longs. So we could either take some of these shorts and move them higher, or we could take some of these longs and move them lower. In this case, we moved some of these 1560s back down to 1550, and that gives us our entry position, which is essentially 0 on the delta range, and gives us a position that looks like this. They're very flat, what we call T plus 0 lines, very flat. This is our expiration line here. Over time, the T plus 0 line drifts towards the expiration line like this. And of course, if we stay down in this range, we make money here, but usually the price moves around quite a bit, so we have to move ourselves around with it. So from here, if we start to get in trouble to the downside, what we're going to do is we're essentially going to roll this position back. In other words, we're going to remove this butterfly and move it to a different level, and we may also move the call. And if the price goes up, we're essentially going to use verticals. So again, you can put those verticals anywhere, but a lot of times we'll either use the short strikes, use verticals to move the short strikes or the long strikes. And we're going to flatten this out to the upside. And if the market goes too high, then what we're going to do is we're going to do another entry test. And depending on what the entry test says, we're either going to pick this up and roll it and move it higher to a higher price point, or we're going to change our configuration into what we call rock configuration. This configuration, by the way, is called M3 configuration. So here is how we start. So what we'll do is we will go forward in time, and I believe we don't need much time, because the very next day, what happens is we end up with a 31.5 point down move in the Russell, which is a fairly large move. And because of that, we ended up drawing down about $821. This is what our position looks like here. Generally, we're going to roll this back if we're more than 10 points under the short strikes, or we're going to roll, a lot of times we'll roll it back if we're over 50 delta to the downside. So what we're going to do here is just going to pick this thing up. So we're at the 1510 butterflies. We'll sell that position off, and we come down to 1480. This time, we're actually able to stay in a symmetrical butterfly, and I think we moved the call also. No, we did not move the call. We're able to roll it back, go into a symmetrical butterfly, and still have relatively flat delta. We're minus 575, and that gives us a position that looks like this. So this is still a nice looking position, other than we're drawn down a little bit here. So let's see what happens as time goes by. So that's May 23rd. Let's just move ahead till the next adjustment, and that would be May 31st. So about 8 days go by, and the market continues down. And again, we're more than 10 points under our strike here, so generally we're going to do a rollback to deal with that. So I'm going to remove this. Let me show you the analyzed graph. We're back to the back side of the butterfly, so we're going to remove this butterfly. We're just going to take it and we're going to move it back. We actually did move the call in this case also. If you see the call, as the market comes down, the delta number on the call, generally we like to see this up over 80 for the most part. It's not mandatory within the guidelines depending on what's going on, but generally we do like to see that, and we did roll this back, so we brought the call back as well to flatten our delta numbers out. We rolled all the way back to 1440. We brought the call all the way down to 1530. If we analyze that, it looks like this. So this is where we were before in blue. This is where we're repositioned to in red. This is still a very nice looking position. Let's move forward. So we move from May 31st to June 4th. What ends up happening here is the market went up a lot. In other words, we had a hard reversal. If we look at our charts, I think we started up somewhere back in here, and we had a sufficient down move to roll us back twice, and now we're getting the whipsaw off the bottom here, and it looks like we're reversing fairly hard. Now, with this position, for the upside, we have a variable delta limit depending on where we are in the tent. So if we're deep in the tent, generally we're going to adjust it minus 100. We get outside the tent, we generally adjust it minus 50. So that's one parameter we have, but another parameter that we have is a vega number. We want to maintain what we call negative vega on this position. If you don't understand what that is yet, that's fine. Just understand this vega number should be negative during the trade. This here, we're clearly positive 40. Another adjustment parameter on this position is if we're 10 points over the long strike. So our long strikes are at 1490. We're at 1503, so we are 10 points over the long strike. We are positive vega, so this does require an adjustment here. And what we're going to do for an adjustment is we're going to take the position off. Well, first of all, we're going to have to roll the position up more on top of the market. If you look at where we are, we're way ahead of where our profit tent is, which is back here. So what we're going to do is we're going to take this off and roll the position up. Now, how we re-enter the market is going to be dependent on what our entry test does. So what we're going to do is we're going to roll this up to 1480, and I'm going to make this a symmetrical butterfly. On our analyze graph. Like this here, and again, we're going to check our delta. This is our entry test. And I'm not even going to consider going into our condor type of position unless we're over 180, and sometimes not even till minus 200. Right now we're only minus 146, even though we're only 17 days to expiration. So that puts us back into an M3 trade. If I go into a symmetrical butterfly and I add my call here at, in this case, 84 delta, I'm only minus 61 delta still, so I'm going to take 10 of these short strikes, and I'm going to at 1480, we're going to move them up to 1490 when we enter, and that's going to give us a delta of about minus 6, which is relatively flat, and it will give us a position that looks like this. So essentially, we're almost right back to starting position here. Unfortunately, we haven't gained any value in the position, but that's just because the market's been moving so much in this period of time. Like I said, it was a challenging period. We had a very hard down move, and now we're having a very hard up move. So we're just kind of following the market here. So let's move this forward. We're at June 4th. Let's move this to the next adjustment, which is June 7th. At this point here, we're minus 75 delta. We are kind of at the edge of the tent, so this is an adjustment point here. Like I said, it's like minus 100 when we're deep in the tent. It's 50 when we're outside the tent. When we're near the edge of the tent, it's like minus 75. So we're pretty much near the edge of the tent here. We're minus 75, slightly over. So we will make an adjustment, and here we're going to just do a vertical and move 10 of these 1490s to 1500. The adjusted position looks like this. Brings us to minus 12. If we take a look at our analyze graph, the blue is before, the red is after. You can see we're flattening out the upside a little bit. We're taking on a little bit of risk into the downside in order to do so. And we continue on. If we go to our next adjustment point, it's June 7th now. We stay in the position till June 13th. You see we are minus 70 delta at this point. We are clearly outside of our tent area. Generally, we're going to be in the minus 50 range. We want to make an adjustment here. So that being the case, what we're going to do is we're going to do a vertical again. These 1500, we're going to buy these 1500s back. We'll sell the 1510s. Again, you could adjust up at this level. You could actually put verticals pretty much anywhere in the range here. But we're choosing to do this, minus 10, plus 10. That brings us back into delta range, and we're sitting outside the tent, but we have a nice strong negative vega afterwards, and we're also not 10 points over the long strike just yet. So that was the adjustment for the 13th. This is the position after the adjustment. And here's how we look. So we're doing okay, but we're not gaining a lot of profits just yet. We're only 8 days to expiration, and this is one of those trades. We started at 30 days, and I'm not sure if I mentioned that, but we started it at 30 days, and it goes pretty much till expiration. So let's move forward here and see what happens the next day, see if we're going to drop back into the tent, or if we're going to shoot up higher, or if we're going to sit here. If we go till Monday, well, we essentially sat here. I think the market dropped down a little bit, then it bounced back up again. We're kind of sitting in what they call the sea of death. Now, as time goes by, this T plus 0 line is going to rapidly start to take on more delta, or our vega is going to become positive. Something's going to happen if we sit here. It's going to trigger off some sort of an adjustment. This case here, we went, again, we're outside the tent. Our delta increased to minus 79. So we're going to make an adjustment there. And again, we're not 10 points over the long strike. We're not really negative, having trouble with positive vega just yet. So our adjustment is just going to be take this time 5 of these. And it's only 5 because I don't want to overdo it. Okay, but it's just taking 5 of these to 15, 20. I think if I take 10, that's kind of overdoing it. That's putting us in a position like this, and we start taking on an awful lot of downside risk. So we opt to go for 5. That brings us to about what, minus 25 or so. That's the adjustment. Here is the new position compared to the old position. Again, straightening out the front line, give us a little more negative vega. If we go to the following day, we got another continued up move. We got 16 points here. We're only 3 days to expiration. We're more than 10 points over our long strike now. Our long strikes are at 1530. Our price is actually at almost 20 points over that with this big move today. And we're clearly positive vega. We have to move the position. So remember the last time we came in, we did an entry test, and we're told to go back into M3 position essentially by the entry test. If we did it this time, we have a much steeper delta. And I'm not going to, well, I will show you. So if I close this out and I go here, let me just close the trades. If I go here, I'm actually at a very steep delta. It's actually minus 464. Right, so if you remember before, I was like minus 140 or minus 150, something like that. Now I'm minus 464. So we go into the more condor type of position. And so what we'll do is we'll buy these butterflies here somewhere 10, 20 points under the money. And then we're going to go up to 40 points higher, up to this other side here. And we're going to buy 7 butterflies at 1570. So we have butterflies at 1530, we have 10 at 1530. In this case, we have 7 at 1570. We're looking for a delta of around minus 180. Again, it's not an exact science, but right around minus 180. And you can see we're in a more condor type of a position here. And what this is going to allow us to do is it's going to allow us to generate profits very quickly should the market stall. And let's see what happens. If we go to, I'm just going to take this adjustment off and advance to the next day. If we go to the next day, what happened is we had another gain to the upside. We have a maximum delta in this configuration at the end of the day of minus 250. We're at minus 375. If we hit the trigger, which we did, we're going to add more butterflies here at the 1570 level, and then we're going to start adding at the 1590 level until we get this straightened out to under minus 180 or around minus 180. Let's see what we come out to. Here we're at minus 151. What we did is we added 7 butterflies at the 1570. We added 1 butterfly here up at 1590, and that gives us a position that looks like this. Now, 2 observations can be made here. One is that we are arguably over $50,000 capital, which was the maximum we were supposed to put in the position. And the other one is that you might ask is, what's the point of selling options that only have 30 cents of time premium? And you're correct in both cases. Now, there's a way that we monitor the position, and there's a way that we actually trade the position. So this is our monitoring position. What we do to deal with the fact that we have exceeded our capital limit is, you can see that the market price of these options is relatively the same. This one's 7 cents, this one's 15 cents, this one's 30 cents. We can literally sell these and even sell this one and bring these down to here. And same thing on the other side. You see, these are 10-cent options. We can literally sell these and say bring these up to here, something that's 30 cents. And for a very small amount of money, we can cut our capital exposure down to under $25,000, but maybe $22,000. This would be our actual position. This position in blue would be our monitoring position. You can see our actual position has much less risk if we get a large price movement. And the cost for doing that is very, very small. We have just a slightly less chance of making money. It does bring down our earning capabilities just a little bit, but it's worth it for the risk exposure. Plus, another thing you might notice too is that we start 30 days to expiration. The next month is 30 days to expiration, which essentially means if I can cut my capital down like this and only have 20,000 in the trade, I can literally start the next trade, because starting capital in the next trade is probably going to be under 20,000 also, and I can run both trades for the 1 day that is left in this position. Basically, this is Wednesday. This trade is going to end on Thursday afternoon, so I can do that for the 1 day, and I can deal with the overlap if that's the case. Okay, but even though we do put this in this position, we still want to monitor it in the monitoring position. So let me clear my trades. And here's what we have here. If we go to the following day, and we look at this position, this is up $8,000. Now we had a $10,000 profit target. We didn't hit our profit target, but we did do very, very well here. And the actual trade did not quite do $8,000 because for 2 reasons. One, we do adjust. Normally this position is only adjusted 1 time per day, and that's at the end of the day. But when we do come into expiration week, if the trade gets way out of whack, we will adjust it during the day. And we had a very large up move early in the trade, and early in the day, and we did have to make some upside adjustments, and then the market came back down, and we took a loss on those adjustments. Plus, we were in capital efficient position, or in other words, we had the wings of the position pulled in, meaning that we lost a little bit on that adjustment, and we lost just a little bit having those wings pulled in, and the actual profit and loss turned out to be, if we look at the reports here, we want to look at this number. Ended up being, this is our open position, so I don't want to look at that. Ended up being this number, $6,200. So regardless, that is what, about 12% or so on our planned capital of $50,000 in 30 days. So that is a fantastic trade, and that is why we love the rock trade. This month's winning trade. So if you like what you see here, I encourage you to join us and discover how you can follow along with this and other great strategies as they unfold during our weekly trade update webinars. Also, I'd like to mention that 2 of our membership levels are currently open for membership. We have something called a Go or Guidelines Options Trading membership, And that is designed to bring you from a beginner to a highly skilled guidelines options trader. And then we have Trading with the Pros for those who'd like to advance to a master level in trading. Membership closes this Friday, and we have absolutely fantastic bonuses to join right now. You've just got to go to lockeinyoursuccess.com and check it out. And that's all I'm going to say. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on the video below or shoot us an email so we can get those questions answered for you. And we would also encourage you to come over to thewinningtrade.com where you can find this episode and past episodes of The Winning Trade, as well as a lot of other fantastic information on income trading. Thank you, and we'll see you on the next Winning Trade.